So when I think about 12 months, we're talking about from an investment perspective, a relatively short period of time. But when I think about the key things that could drive these assets, particularly the share price side of these assets over the next 12 months, call it into 2026, what we're really talking about is a couple of big things. One is that it really depends on how the economic story develops from here. Obviously, there's plenty of uncertainty as we sit here today, particularly in places like the United States, as to how we progress from here. And there's a lot of question marks as to the strength of the US economy. What is interesting from our perspective is, from certainly a relative perspective, infrastructure versus, say, general equity investments, is that if you saw economic weakness, we would expect that the infrastructure companies in which we invest would hold up particularly well in that environment versus the broader market. So we'd expect that would be sort of, call it a relative positive. Now, that is not to say that infrastructure would not decline at all. You'd see the share prices go down, but the underlying earnings would not be as much of a decline. You'd expect that to be supportive. The other thing that we certainly think about, sticking on that sort of macro lens, is the path of interest rates. We're certainly less, call it, fixated on the path of short-term interest rates. But for us, what we have experienced is that the longer-term interest rates tend to have a reaction with the share prices. So you'll find that when interest rates go up unexpectedly, that can have an impact on the share prices in the short term. For better or worse, the market trades some of these companies a bit like a bond proxy. Now, I'd add as a long-term investor, that can create opportunity for us, and it certainly has in the past if share prices overreact. But that's something that could happen. And then the black swan one, that's kind of interesting. The part that could play out here is, I spent a little bit of time thinking about how we've got the growth in data centers really benefiting some of the utilities businesses in which we invest. What you could see happen, and obviously right now we're still seeing hyperscalers and cloud companies talking about growth in CapEx numbers. But if we saw that sentiment shifted and CapEx was pulled back, you could see at the margin some of the growth coming through those companies slows down to a degree. I think there'll be always things to backfill with these companies, but you could see that slow down over the period. And I think that would sort of create a sentiment issue. But I would say, again, I expect there's probably other pockets of the market that would be more concerned about that than the regulated utilities out there. So I hope that gives you a bit of color to some of the things that we're certainly thinking about over the shorter sort of time horizons.